Hey guys, welcome back. In my last video earlier today, I talked about proper fundamental analysis of GameStop and how understanding that can assist you in your trading strategy of GameStop. Whether you're a swing trader like me or a person who just likes to buy and hold, I think it is important to understand how the market is looking at the fundamental value of GameStop. And you could have a different theory for yourself about the fundamental value of GameStop, but that doesn't change the fact that the market has a very traditional way of looking at fundamental value. I hear people on social media every single day telling you different price targets or different ratios that they're looking at to calculate a $50, $60, $100 price target for GameStop. And without exception, I'm hearing people give you bad information. They are looking at things that nobody who's taken a finance class would ever look at. So what we're going to do in this video is break down how to do a proper fundamental analysis of GameStop share price, what predictions we can make about where the share price should be valued, both right now and at the end of their fiscal year, which will be February 2025, with the data that we currently have. Now, things could change if Ryan Cohen and management make some announcement about a acquisition or a reverse merger, anything, really anything that they decide to do with the $4.6 billion that they have sitting on the balance sheet could change what we're talking about today. But for today, we're trading today. We need to understand how the market is looking at it today. And then if you want to have other theories beyond that, that is fine. So we're going to show you the math. We're going to cite sources. And if you find a fundamental flaw in the math and the finance work that I present to you in this video, drop me a comment. I'm happy to engage with you guys on facts. What we're not going to do is speculative theories about wild assumptions, wild guesses of where the price should be based on nothing but speculation. You can have your wild speculation, and that's fine. Just call it a guess. But in this video, for those of you that want to learn how to do this stuff, we're going to do traditional fundamental analysis, and I think it will help you in your trading if you're willing to listen. With that being said, let's get right into it. The biggest issue that I see out on social media is people focusing on ratios that don't matter currently for GameStop to extrapolate a future price for GameStop. They focus on just the balance sheet, just book value. They are wanting to talk to you about the solvency ratios or the liquidity ratios, the current ratio, the quick ratio, the debt to equity ratio, or just the book value of the company, the assets minus the liabilities. Book value is related to analyzing a value play, and GameStop is not a value play by definition because the market cap far exceeds the book value of the company. I am a value investor. I look at value stocks all the time, and the very first sort that I do to find a value stock is the market cap lower than book value? And if it is, then I have a potential value play to consider and do some more work on. GameStop is not a value play. It has not been a value play since 2020 when Keith Gill started looking at it. So nobody should be looking at book value or talking to you guys about book value and how you should have a $50 or $100 price target on GameStop based on book value, because this is not a value play. Because the market cap is over book value, GameStop is not a value play. Is it a growth stock? It's not a growth stock either. A growth stock would be defined as a company which is expected to grow faster than the overall market, and GameStop is in a declining revenue situation, not a growth revenue situation. This is a company that has profits. Even if those profits are coming from interest income, there's still profits, and the company will be profitable at the end of this year. So based on the fact that they have profits, we need to look at the columns over here on the right: profitability ratios, market ratios, and valuation ratios. And I've been begging the GameStop YouTubers to start talking to you guys about this stuff, because if you're not learning this stuff, that is a disservice to you, the viewers. You need to learn how to properly value the stocks, even if the answer is uncomfortable, even if the answer is something you don't want to hear. That is how the market is valuing GameStop right now. And If you're wondering why the price is not being pushed up like the other YouTubers are telling you, it's because the market is willing to suppress or short the price of the stock due to profitability or valuation ratios, which is what you should be using, what you should be looking at right now, this moment on GameStop. If you've been following my channel, you know it is no secret that I've been swing trading GameStop for 2 years now, and my trades are always up here on the screen for you to review. I am swing trading GameStop, even though I know that it is overvalued. I'm just looking for opportunities to dip in when the chart says it's a smart time to buy and sell into any run-ups. But I always keep in the back of my mind, what is the fundamental value of these shares? What is the fundamental value of the stock, so that I don't overpay for those shares and that I keep my risk management in line and I don't overcommit to this play while the price is overvalued. And then we hope and we pray that Ryan Cohen has a plan that he announces that one day will justify this current price that we're seeing in the market, or even something higher. I don't know if that will happen. Maybe it will. And I hope that it does for all of you that need it to happen. But right now, in this moment, we have 2 days data, and it is important for all of us to understand how the market is driving the fundamental share price of GameStop, the value of those shares, so that you can use that if you wish. Some of y'all might not care about it. That's fine. It doesn't matter to me, but I use it. I use it in determining where I want to get into this play and how I want to manage my risk. We're going to look at my spreadsheet in just a second, including expectations for GameStop's profits for the full fiscal year and what share price we can derive from that. But while I have this slide up on the screen, I want to say again, if you haven't watched any of my previous videos on this topic, the far right hand side is the ratios that you should be looking at to understand what is happening to GameStop's price today. Things like the price to earnings ratio, the EV to EBITDA ratio, or the free cash flow yield. Other things that I would suggest you get up to speed on would be return on equity or return on assets. Just to kind of kick us off here, when you hear people say that GameStop is overvalued and that just smacks you as offensive, I would encourage you to use some tools and compare GameStop to other companies in its sector. Now, you could pick whatever companies you want. I've just selected here the specialty retail sector to get a wider cross section, and you can see GameStop with a PE of 152, a price to EBITDA of 338, and an EV to EBITDA of 214 is wildly overvalued to almost every single stock in this list. I highlighted Best Buy in green just as a random pick, but you should compare GameStop to everything in this list to just get a flavor for what do people mean when they say that the current price is overvalued, because the lack of earnings and the sky high price relative to those earnings for GameStop is what is making these particular ratios so out of whack to GameStop's peers out there in the market. It's not enough to exclaim, guys, we're profitable, if the profits are so meager that it throws all of these ratios out of whack. Your price is going to be pushed down until the ratios make sense. We can look at similar valuations on a site like Morningstar, or we can look at price to earnings relative to the index, price to cash flow relative to the index, enterprise to EBITDA, a sky high number relative to the index, even though they don't show the index there. And then we have some of the metrics looking at operating performance. Let me scoot this data over. We can see GameStop's trailing 12 months return on assets, return on equity, return on invested capital, 1% or a negative number relative to what the index is trading like. And if you want to be in an index like the S&P 500, bros, you're going to need to pump these numbers up. How do you pump up these numbers? More earnings. Now, I know the next thing that you're going to say, and it's a logical thing to jump to, is that, Tony, you're forgetting that GameStop is going to make a metric ton of money from interest income off of $4.6 billion on the balance sheet in cash. So let's take the next step and break down here with the spreadsheet. What is that really going to mean to GameStop or to you as an investor? Because again, this is basic finance 101 math. It's very easy to do. We're going to do it together here very quickly. Let's get right into it. To do the full analysis on GameStop, we need to make some assumptions about revenue, for the last 2 quarters and the entire fiscal year. And look, I, just like you guys, don't know exactly what it's going to be, but we know it's on a downtrend. So just for the sake of this video, this is not my prediction, because how the heck do I know? We're going to use what the analysts are predicting for GameStop revenue. And if you want me to use some other numbers, we can certainly put them into my spreadsheet. It's just changing one square, one cell in the spreadsheet, and we can generate a whole new list of results. But we are going to use the numbers from stockanalysis.com and yahoofinance.com. They're very similar on expectations, probably because there's only one, maybe two analysts providing the data for GameStop. Again, you might not like the data. I might not like the data. It doesn't really matter. We're just going to use this data for the sake of this video and see what we get for the final result for GameStop, both from earnings from revenue and interest income. When we have those numbers, we can apply a market rational PE ratio to them and get a estimated price target for GameStop by the end of their fiscal year. What the market is going to try and drive the price to. Again, you can have whatever price you want. I don't care. I'm just trying to walk through how is the market valuing GameStop. That doesn't mean that it's going to trade all the way down to that price. Don't twist what I'm saying. This is a exercise to understand how the market is valuing GameStop so that you can improve any trades that you take and your risk position on the play. As we're looking at this spreadsheet, I'm trying to give the absolute best case scenario on margins and SG&A. We're going to talk about that, but using the numbers that the professional analysts are expecting for revenue. So we're going to say 875 million in revenue for Q3, 1.5 billion in revenue for Q4, giving the company a total for the fiscal year just over $4 billion total revenue. Let's say that in both Q3 and Q4, they maintain a high gross margin similar to what they did in Q2. I have here 31% for Q3, 30% for Q4. SG&A cost as a percentage of net sales has been creeping up this year in Q1 and Q2 relative to the percentage of net sales in 2023, but we're going to be even more favorable to GameStop in Q3 and Q4 for the sake of this example, and say that the SG&A percentage of net sales decreases to just under 31% in Q3 and all the way down to 21.6% in Q4. In those scenarios, we have a positive operating income. If all goes this well, $1 million positive operating income in Q3 and $125 million positive operating income in Q4. Again, this is just an example. These are not my predictions. The next thing that we're going to look at is the interest income. Let's assume for the last 2 quarters of the year, Q3 and Q4, that the company has $4.6 billion in cash and that they are able to earn 4.5% on that per quarter. That would yield just over $51 million interest income per quarter. When we add those numbers up, the net income from operations plus the interest income from the cash on the balance sheet, we have a net income 52 million positive for Q3, 176 million positive for Q4, giving the company a total net income for the fiscal year positive $210 million. When we add that up and look at the total for the year, that gives GameStop a total annual EPS of a positive 47 cents per share. The problem is, friends, when we take that 47 cents and apply a market norm PE ratio of say 25, we get a price target based on this very fantastic earnings of $11.75. And that, my friends, is how people like Michael Pachter are coming up with a price target in the $11 range for GameStop. Even if you make a lot of very favorable assumptions for GameStop and count all of the interest income, you still have a hard time getting a price target over $12 using traditional Finance 101 financial analysis to derive a share price off of a very normal PE ratio. And you're going to say, Tony, let's double that PE ratio. If you double the PE ratio, you get something in the neighborhood of where we're trading right now. And then the question that you need to ask yourself is the market going to allow GameStop to trade at a PE ratio twice its competitors out there? That, my friends, I cannot answer for you. That's many, many months down the road, and I don't have all the answers. The exercise that we were attempting to do today was to walk you through a valuation analysis of the share price to explain to you how the analysts or anybody on Wall Street is currently looking at the share price valuation GameStop. They are not willing to assign a 50 PE ratio to GameStop. They're assigning about a 25 PE ratio to GameStop based on what I can decipher from the price targets that they are publishing and my spreadsheet to do some of the work to see how they get there. Hopefully this was helpful for you guys to understand how these analysts are coming up with their current price targets. You saw all the work right there in the spreadsheet. They have spreadsheets very similar to this. The only way that this really changes is if the numbers substantially change. If the revenue at the top of the income statement changes, if the margins change, if the SG&A improves, all of that has some bottom line impact to the numbers, but it is minimal impact. I mean, even if you had a few $1,000,000 difference, it's going to only make a couple pennies difference on the annual EPS. And it's just very tough to bridge from $11 and change to $20, $21, $23. There's not enough on the income statement to make that sort of jump. And then the discussion maybe we'll turn to what is a proper PE valuation for a GameStop. And I'm not the arbitrator of that. I'm not the decider. The market will decide on that, and it'll be fun to watch and see what happens. And really, at the end of the day, the way to change this game is for Ryan Cohen and management to jump in and let us know that that cash on the balance sheet, which is not being used in any way to derive a price target for GameStop, put it to work. Put it to work to increase the earnings. Increasing the earnings is the key to getting a valuation that you might be hoping for GameStop. So just like you, I will be waiting to see what Ryan Cohen has in store for us and what the timeline for that is. That is another big question. Is this going to happen soon, or is it going to happen maybe months or a year from now? Again, I don't know. I'm waiting, and I will be positive just like you guys are and hope for the best. I don't short GameStop. I don't want Ryan Cohen to fail. I don't want GameStop to fail. I don't want any of you to fail. I'm not against any of you. I want to trade this stock profitably, and I'm sure you want to do the same thing unless you plan on never selling, in which case, why are you even here, bros? Let me know your comments down below. I am Tony Denaro, and I will see ya on the next video.